In today's video, we're going to take a close look at SCHD and VIG, the Schwab US Dividend Equity ETF and the Vanguard Dividend Appreciation ETF. And by grading all aspects of these two ETFs, we'll answer the question: which one is the better dividend ETF? So we will analyze and grade 7 different aspects: ETF strategy, fees, diversification, sector exposure, volatility, performance, and dividend yield. These two ETFs are head-to-head on most aspects, including long-term performance, so be sure to not skip any point. And now let's go right to the first aspect, which is a strategy. VIG, the Vanguard Dividend Appreciation ETF, is the oldest of the two ETFs and is comprised of dividend growth stocks, namely companies with a history of increasing dividends over time. Specifically, VIG tracks the S&P US Dividend Growers Index, which is comprised of stocks that have consistently increased dividends every year for at least 10 consecutive years. When the index is reconstituted annually in March, companies are ranked by their annual dividend yield, and then the top 25% of companies with the highest yields, or 15% for existing constituents, are removed. The individual holdings are then weighted by market cap and have a maximum index weight of 4%, which helps preserve diversification. SCHD tracks the Dow Jones US Dividend 100 Index, which aims at finding high-quality, sustainable dividend-yielding companies. The index comprises 100 stocks with at least 10 consecutive years of dividend payments and a minimum market cap of $500 million. Stocks are then selected for the index by screening for yield, profitability, and cash flow metrics like free cash flow to total debt, and projected dividend yield and growth. Individual companies are capped at 4%, just like for VIG, and sectors at 25%. A lot of important factors are used to find and select value companies that are able to deliver stable and high dividends in the long term. So there is a great focus on value and long-term stability of the dividend yield. Since the ETF strategy of SCHD is so sophisticated and includes profitability and cash flow metrics, I'm going to give 7 points to VIG and 9 points to SCHD. The second aspect is fees. Both VIG and SCHD have an extremely low expense ratio of 0.06%. This means that with a $10,000 portfolio, you're going to have to pay $6 per year on fees. And there is only one thing that is cheaper than this, and that is dropping a beautiful like to this video, because it's free for you, but it really helps my channel a lot. So thank you very much for it. Now, when it comes to expense ratio, this is something that people often underestimate and invest in ETFs with expense ratio of like 0.6%. The mistake they make is they think, come on, 0.6% means just $60 for every $10,000 portfolio. It's not such a big deal, right? Well, it is a big deal actually. In fact, if you really want to know which damage the expense ratio is going to do to your wealth, you shouldn't compare it to your portfolio value, but to your annual growth. Because if your $10,000 portfolio gives you a yearly return of like $600 and it's $60 in expense ratio, every year you're actually going to lose 10% of your returns. 60 divided by 600. And this is going to happen every year. So you see how 0.6% of an expense ratio can actually become a terrible 5, 10, 15% if you see it from the right perspective. Really important to remember this. And now coming back to our ETF, I'm going to give 8 points to both VIG and SCHD because they both have a great expense ratio. And SCHD leads now with 17 points against 15 of VIG. The next aspect we're going to look at is diversification. VIG contains 314 different companies, while SCHD has 104 holdings. The main holdings of VIG are Microsoft with 4.84%, Apple with 4.67%. Wait. You said before that the weight is kept at 4% for each holding. So what is this now? Well, the weight is kept at 4% at the moment of the annual reconstitution and at the quarterly rebalances. But then stock prices change and company can also go over 4%. So coming back to VIG, after Microsoft and Apple, we have United Health Group, JP Morgan, Johnson & Johnson, Exxon, Procter & Gamble, and so on. The total weight of the top 10 companies is 31.37% at the end of August 2023. The top holdings for SCHD are Amgen with 4.43%, Cisco Systems with 4.35%, Broadcom, AbbVie, Home Depot, and so on. And the total weight of the top 10 companies is 40.78%. In terms of assets under management, VIG manages $68 billion, and it does this with more diversification through 3 times the numbers of holdings of SCHD. SCHD instead has $48.8 billion in assets under management. Since you might invest in both ETFs, we should also look at the holdings overlap between the two ETFs. Basically, the companies that are included in both ETFs. There are a total of 30 companies which are included in both ETFs, which means that 29% of SCHD is included in VIG and 9.5% of VIG is included in SCHD. Considering the higher diversification of VIG, the lower concentration on the top 10 holdings, and also the higher assets under management, I'm going to give here 8 points to VIG and 6 to SCHD. So now VIG and SCHD are both at 23 points. Moving on now to the next aspect, we're going to analyze the sector exposure of the two ETFs. First off, both ETFs exclude REITs. SCHD is tilted more on large cap value, whereas VIG has more of an allocation on large cap blend and growth. SCHD has a strong exposure to industrials and healthcare, with the financial sector following with 14.54% and losing its high position that it had at the beginning of the year because of the financial crisis and also the last reconstitution in March 2023. VIG focuses more on information technology, so companies like Microsoft and Apple, followed by financials and healthcare. I personally like that VIG doesn't have such a strong weight in the energy sector. Not because it's a weak sector, of course, but because the growth of the stock prices in the energy sector in the past few years exceeded the actual growth of the energy companies. And don't get me wrong, energy companies did have a huge increase in sales due to high energy prices, but this was due to a combination of many factors, including global energy crisis, inflation, and war in Ukraine. Generally speaking, I prefer the sector exposure of VIG, also because of my tendency to be bullish on technology in the long term. But SCHD also have a great composition with more value, which by the way might even perform better than growth in the next decades. So it's a hard choice, but I'm gonna give 8 points to VIG and 7 points to SCHD, bringing VIG to 31 points against 30 of SCHD. Moving on to the volatility, we're gonna use two important ratios. The first one is beta, which is a measure of a stock's volatility in relation to the overall market. So by definition, the stock market gets a beta of 1.0, and stocks in ETFs are ranked according to how much they swing in price compared to the market. A stock that swings more than the market over time has a beta above 1. If a stock moves less than the market, so it's less volatile, the stock beta is going to be less than 1. VIG's beta was around 0.86, 0.87 in the last 3 to 10 years, showing less volatility than the market, which is great. But SCHD had an even better beta in the last 3 years with 0.81, although in the last 5 and 10 years it was up to 0.88, 0.89. So pretty similar results, and sure, a sign that both ETFs are stable in the long term. The second ratio is the so-called Sharpe ratio, which gives us additional information because it not only considers volatility, but also performance relative to volatility. In particular, it divides an asset's excess returns, which is the returns minus the ones of a risk-free asset, by a measure of its volatility to assess risk-adjusted performance. Basically, the higher the Sharpe ratio, the better. By analyzing the Sharpe ratio of the two ETFs in the last 10 years, you notice that during the first 5 years, from 2014 to 2018, SCHD presented a slightly higher Sharpe ratio, while in the past 5 years, except during the crisis in 2021, VIG's Sharpe ratio has been higher. So I'm going to give here 8 points to VIG and 7 points to SCHD, which brings VIG to a total of 39 points against 37 of SCHD. Alright, the next aspect now is performance. We're getting now to the two most beloved parts of an ETF comparison, which are performance and dividend yield. And if you haven't done it so far, consider subscribing to the channel and maybe even dropping a beautiful like to this video if you appreciate my work. Now, when it comes to performance, past performance is never a guarantee of future results. We are going to analyze the past performance of these two ETFs to try to understand their potential and their stability over time. But this doesn't give us any assurance that they're going to behave in the same way in the future. That said, here's a performance backtest of the two ETFs going back to SCHD's inception in 2011. VIG, which is the red line, was basically always a step behind, even though they closed with a total average yearly return, which is pretty similar, with 12.19% for SCHD and 12.32% for VIG. Both wonderful results, with SCHD being a little bit better. In fact, by investing $10,000 at the end of 2011, you now have $41,000 with SCHD against around $38,000 with VIG. So SCHD could be a better long-term hold, but still, as you've seen in the past 2 years, market conditions can change quickly. Even though in the long term SCHD performs slightly better, had you just started investing in SCHD this year, you may be frustrated, if not pissed off. Because year to date, VIG delivered 6.23% and SCHD is down 1.52%. So you might be wondering, Why is SCHD so loved? It's important to know that only a handful of mega-cap tech stocks actually pushed VIG's results this year. And in general, short-term performances are usually misleading. If you invested in SCHD this year, you didn't make a poor choice. Instead, you need to understand that these short-term results are driven by market sentiment. So the only thing that really helps you with investment decisions is actually evaluating an ETF's real fundamentals. For example, since you can simply assess a dividend ETF by its past performance, you should check factors that determine profitability and quality. SCHD screens its stocks based on free cash flow to total debt, return on equity, and 5 years dividend growth rate. And this is a great way to give exposure to companies with high profitability. This doesn't mean, of course, that on the other hand, VIG is a bad choice. Since its launch in May 2006, VIG has gained an annualized 9.53% versus 9.85% for the SPDR S&P 500 ETF Trust, and experienced less volatility, which led to better risk-adjusted returns like the Sharpe ratio and the Sortino ratio. Summarizing, VIG has given a better one-year performance. They both had a similar performance in the last 10 years, and SCHD has a better performance since inception. Two great performers, wonderful returns in the long term. I'm gonna give 8 points to VIG and 9 points to SCHD for the higher performance of the long run, bringing VIG to 47 and SCHD to 46 points. So now let's move to the final aspect of a dividend ETF, the dividend yield. VIG has a dividend yield of 1.93% and paid $3.11 per share in the past year, growing 8.56%. The dividend payout ratio, which represents the dividend paid by the company divided by the net income in the same period, is a solid 43.72%. Just to give you an idea, a payout ratio around 50% plus minus 10% can be seen as a good ratio. If it starts growing over 60, 70%, it means that the company is giving out too much of its earnings as dividends, and it might signal that the company can't grow anymore. SCHD, on the other hand, has a much higher dividend yield of 3.55%, with a dividend growth of 7.13% and a payout ratio of 49.34%. If we compare the last 10 years of dividend payments, you can see that SCHD has managed to keep a higher dividend yield over the long term. So for those of you that are looking for dividends, SCHD is for sure the winner here. I'm gonna give 6 points to VIG and 8 points to SCHD when it comes to dividends. And this brings SCHD to be, again, the winner, with a total of 54 points versus 53 of VIG. SCHD and VIG are both great investments for the long term. So if having a larger basket of stocks and less volatility helps you sleep at night, VIG would be a better option. If you instead seek the highest possible returns and dividend yields, SCHD might be a better option. I hope I could give you some interesting information with this video. If I did, don't forget to subscribe to my channel for more videos like this. And let us all know if you favor SCHD or VIG. If you missed it, check out my last video about SCHD, which I'm gonna link here. Thank you so much for watching this video, guys. I wish you a great day or evening, and as always, I'll see you in the next video. Ciao.